Hey everyone, welcome back to Corporate Dakota, the place where we shed some light on those lengthy financial reports that most people skip but hold the real secrets of big companies. Today we are diving into some news from Light and Wonder Incorporated, and let's just say this report is less about a massive financial shift and more about a significant financial adjustment related to their debt. So, grab your coffee and let's decode this. First off, a quick intro for our new viewers. If you like getting straight to the point on what matters in corporate filings without the jargon, make sure you hit that subscribe button. And hey, if you want to chat about these filings or anything else finance related, join our Discord community linked in the description below. So, what is the big news here? Light and Wonder Incorporated, or L&W as you might see it traded, has made an update to a major loan agreement. Think of it like refinancing your house, but on a much larger scale for a big company. This isn't your everyday kind of update. It involves changes to a credit agreement, which is basically a fancy term for a big loan that companies use to fund their operations, growth, or other big projects. The main event here is an amendment to their credit agreement. This amendment, called Amendment Number 4, totally shakes up their outstanding loans. They are essentially replacing their old loans with new ones. And get this, the new loans are for a whopping $2.13 billion. That's a lot of zeros. These new loans are set to be paid back by April of 2029. This move is all about managing their debt. Companies often do this to get better interest rates or to extend the time they have to pay back money, which can free up cash for other things. But it is not just about the amount of money. The interest rates are also getting a makeover. The amendment is lowering the interest rates on their loans. For loans tied to certain benchmark rates, the interest rate is dropping to 2.00% per year. And for loans based on the ABR, which is the alternate base rate, it is going down to an even lower 1.00% per year. Why is this important? Lower interest rates mean the company pays less money in interest over time. This directly impacts their profitability. Imagine paying thousands less on your mortgage each year. That is extra money you can use for other things. For a company like Light and Wonder, this means they can either keep more of their profits, reinvest in the business, or pay down other debts faster. It's a positive sign for their financial health and their ability to manage their obligations. Now, this filing is a formal record of that agreement. They've attached the actual amendment, Exhibit 10.1, which is the full legal document. This is where you'd find every single detail if you wanted to get into the nitty-gritty of the terms. For our purposes today, we're focusing on the impact and what it means. Let's not forget who we are talking about here. Light and Wonder Incorporated is a major player in the gaming and lottery industry. They are involved in creating a lot of the slot machines you see in casinos, and they also have a significant presence in the lottery technology and system space. This industry is highly competitive and relies heavily on innovation and capital investment. Refinancing debt like this often signals a company that is confident in its future earnings and its ability to manage its financial obligations. Also, it is worth noting that their common stock was previously listed on the Nasdaq stock market, but they initiated a process to delist it. This often happens when a company decides to go private, is undergoing a major restructuring, or if the costs of being publicly traded outweigh the benefits for the company at that specific time. Their stock ticker was L&W. While this filing is about debt, the delisting is a broader strategic move. It means fewer public investors will have direct access to trading their shares. So what is the big story here? Light and Wonder Incorporated is actively managing its finances, specifically its debt. They have secured new, and importantly, cheaper loans. This is a strategic move to reduce their interest expenses, which should improve their bottom line. It shows a level of financial maturity and foresight. Instead of letting old, potentially more expensive debt linger, they are proactively refinancing. Now let's look at this from a broader perspective, a sort of Warren Buffett style analysis from what we see here. Light and Wonder is prioritizing financial stability and efficiency. Reducing their cost of debt is a direct way to increase shareholder value without necessarily needing to increase revenues significantly, though of course that is always the ultimate goal. The sheer size of the loan indicates significant ongoing operational needs and perhaps future investment plans. The fact that they were able to secure these new loans with lower interest rates suggests that lenders still have strong confidence in the company's long-term prospects and its ability to generate consistent cash flow. This is crucial in the capital-intensive gaming industry where large investments in technology and infrastructure are common. One notable risk is always market volatility and regulatory changes in the gaming sector. However, this specific filing is focused on debt management, which is a proactive step to mitigate financial risks. The opportunity here is clear. With lower interest payments, the company has more financial flexibility. This could mean more resources for research and development of new games. expansion into new markets, or even potential acquisitions. In conclusion, this amendment to their credit agreement is a positive step for Light & Wonder Incorporated. It demonstrates sound financial management and a commitment to optimizing their capital structure, while it is not a flashy new product launch or a massive revenue surge. Managing debt effectively is a quiet but powerful way for a company to strengthen its foundation and position itself for sustainable growth. It is a sign that even large corporations are constantly looking for ways to make their money work harder. Alright, that is our breakdown of Light & Wonder's latest filing. What is your take on these debt moves and what they signal for the company's future? Do you think this was a smart strategic move? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And of course, subscribe for more corporate deep dives. Don't forget to check out the Discord link in the description to continue the conversation. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.